Hi, my name is Josh Malancuk, President and CEO with JM Tax Advocates, and I am here to discuss a very important topic these days about COVID property tax relief planning. Specifically, we are here to help you understand how best to manage and avoid unexpected property tax increases during this recession. About my background. I've spent the past 28 years serving some of the largest capital-intensive clients as a national tax specialist by advocating for lower property taxes and attaining maximum level economic incentives during their business growth. Prior to founding JM Tax Advocates 11 years ago, I built 18 years of public accounting experience by serving as a national property tax practice leader for a top 10 regional accounting firm and in the capacity of a national Big Four firm-wide tax director. As a starting point, it's important to understand the who, what, when, where, why, hows for property tax relief. Specifically, let's go over the following questions with answers. Who is responsible for assessment? What property is taxable or exempt? When is property valued? Where should it be assessed and how is it assessable? So first off, who is responsible for assessing property? Well, that answer depends on whether you're talking about personal property or real property. In general, real estate is assessed by a county or state assessing official by comparing the personal property, usually starts with a self-assessment on a personal property tax return filing, and later a certification or an estimate of value by a local or state assessor. So what property is taxable or exempt? That's really an important question because the answer may vary depending on the state for the filing or based upon the state of assessment. When is the property valued? Well, most often the answer is January 1st, although several states have alternative assessment and lien dates for property assessment, so it's important to know your state. Where should it be assessed? That answer is easy. The property should always be assessed for taxable property based upon the property situs or location as of the assessment date. How is it assessable? How the property is assessed can really vary depending on whether it is deemed to be exempt or excludable, or if the value premise is different than fair market value. That methodology may also vary greatly. Again, it's important to understand your state assessing methodology so that you know how best to evaluate your assessment notices year after year. It's important to not forget about property taxes. How many times do I see a business that is managing on a percent change method from year after year? In other words, if the value doesn't change much, there's no action, no review. Using that percent change method can really create some unexpected surprises when property tax rates are expected to fluctuate from year after year, such as these times. So don't forget about property taxes. That's really important. Most of the time, capital-intensive businesses are paying significant sums of property taxes. So that's why it's important to manage your property tax levels. It's likely that if you are a capital-intensive business, property tax is your number one or number two tax burden. It's staggering to know that 80% of the time we find savings or overages with assessments by as much as 20 to 30%. Imagine being able to take that overage, possibly in the hundreds of thousands or millions of dollars, and put that to better use in other strategic areas of your company. That is really why we're here today, to talk about how you can best change your management of property taxes to work for your company instead of against it. Property tax periods are almost always time sensitive to a particular period or particular date during the year. So it's important to know your state and local appeal and amendment deadlines. Another area that's important to understand, especially these days, is that the tax rate, which is applied to your assessment to come up with your tax bill, may create surprises if that rate fluctuates wildly during COVID times. We also expect that starting with this year's assessment, there will be even larger assessment disparities between what the assessment notice says and what is fair, accurate, and equitable for you as the taxpayer in that jurisdiction. So I encourage you to not forget about your property taxes. Despite all the pain and unpredictability and disruption to your business that COVID has rendered, COVID relief may be available and can actually work for you when you're talking about reducing your property tax assessments. COVID may impact the value of many different property types. Some of the symptoms of loss in value typically stem from a business decline in revenue, utilization, occupancy, and rising costs of doing business. The impact may vary depending on the property type. There'll be lots of winners and losers with all of this, so it's important to understand the impact and value for your property. Future property tax rate increases may also create this perfect storm with extraordinary property tax bills that can otherwise be avoided through relief planning. Your state or local assessor is not likely to capture the loss in value due to COVID. So it's important that you, as the taxpayer and any property tax advocate, to pay close attention to symptoms of economic loss or obsolescence, so that is properly implemented in your assessed values of real property and possibly personal property if that's assessed in your particular state of operation. It's important to understand how COVID can materially impact your assessed value if you've been impacted. It's important to ask some good questions that would lead you to believe that, yes, indeed, COVID has impacted my property value. Yes, indeed, I should be concerned that I'm not overpaying this year with assessments. If your sales revenue has been declining, if you're incurring additional expenses that you've not seen historically, if your business has been facing equipment in a downtime with shutdowns and utilization has been impacted, have had to lay off people in my workforce, and what's going on with my supply chain? Have I seen disruptions with getting my raw materials or component parts? Am I seeing increased costs of freight and also with components because of a number of reasons? Well, if enough of these are yes answers, you probably have a case for COVID relief for your property assessments. Understanding the external forces impacting the property type that you're dealing with is that important initial step for planning a property tax review. The next step involves building a business case for assessment relief. There are numerous common appraisal methods that are both qualitative and or quantitative in nature, with the whole goal to measure the loss of value for either real or personal property. So where do we begin to investigate and highlight planning opportunities in overage with property assessments? Well, that usually starts with looking at the latest property tax bills, looking at the last assessed value, reviewing personal property filings and fixed assets to start to formulate some initial areas of investigation. We find that attending tours and meetings with facility and accounting personnel is always a great step, with some interviews to understand the function and history of the property that we're reviewing. Fundamental market analysis is also the center point for the property tax review, because we're wanting to compare the initial assessment data or latest assessment data as part of our preliminary gathering and investigation. It's extremely important to map out a deadline calendar to build that predictability for action and to anticipate when protest periods end, so that is planned into the property tax management and review function for the current year. Then leading up to that point where you receive the notice, you'll have that market analysis, that fundamental analysis in hand. Potentially, you'll have amended returns ready to file and have some positions to implement in the current year filing, so that you're already starting to achieve relief as part of the property tax management planning. Once you've taken action, either through appeals or amendments, the last step is key to know you've crossed the finish line, that the settlement of the expected assessed value through amendment has been properly implemented through a tax bill review. If the tax bill is not correct, many times there'll be some time-sensitive action to get that correct so that you're not overpaying as part of your payables process for that year. So what do we find once we've reviewed properties? What I can say is that almost always we find that assessments are not correct. But during COVID times, when a property has been greatly impacted by the current recession, we could see overpayments by as much as 70% or more with assessment differentials in comparison to an accurate market value. Some of the common assessment mistakes that we typically find after we have completed our diligence for analysis and review include, first, is that there's a disconnect between market value and assessed value. Second, is that there is not what's being assessed currently present at the subject property. In other words, are all of the physical features of the building correctly being captured on your assessment record? And many times they're not, because of omitted land use restrictions, or maybe the assessor got the square footage of the building wrong. There's all kinds of factors that go into rendering an accurate assessment. So it's important to study all of these factors to make sure that you're getting a fair shake. Third is with correcting incentive errors. Specifically, after you've negotiated incentives through a lot of hard work, are you getting what was negotiated as part of the actual incentive computation? A lot of the incentive benefits flow through on your property tax bill. So you want to pay attention to your property tax bill to make sure that the incentive amounts are as expected. Fourth, applying additional personal property obsolescence for overall value determinations. Obviously, you have to be in a state that assesses personal property for that to be a planning item, but personal property, especially with manufacturers, is a big area to review and investigate to make sure that you're getting all forms of depreciation applied on your personal property for physical, functional, and economic depreciation sources. Fifth, finding additional pollution control property tax exemptions. As in most states, there is an incentive to do the right thing as an employer, to minimize emissions to the environment, especially with air and water. Because of that, you'll want to understand if your state exempts pollution control property, because once you properly claim this system, you'll likely never pay property tax again, or the amount will be dramatically less than your other property types. Sixth, segregating the components of your assets may actually lead to property tax relief. So it's important to make sure that you understand what exclusions or exemptions are available in your state, because segregating those items can actually lead to relief while completing the returns. Seventh, correcting double taxation of the same property. For instance, in some states, we actually have found that property is being reported on personal property filings and also being assessed again as real estate. Knowing all of the factors and components that go into your real estate can help you identify double valuation situations. Then the last item has to do with property tax abatements, and errors that come up with reviewing an actual tax bill. In case you're wondering, does this even mean much to me? My property tax bill is what it is every year. We're highlighting some examples here with businesses that were maybe somewhat active with reviewing their property tax amounts year after year, or maybe just not much at all. You can see that the economic benefit that was achieved by just managing the property tax amounts in the spirit of minimizing, reviewing, and implementing process changes and keeping the assessor accountable. The first one had to do with an automotive manufacturer, Tier 1, and their study resulted in a $7.1 million amount for relief. The next example was with a major food ingredients manufacturer. They did a statewide review with our team for all of their properties. And again, we're on a percentage change kind of management. Many of their properties had not been appealed for years. We were able to help them secure a $1.7 million reduction across the board and a gift that is kept giving to them with an annual savings of $400,000. This third example was a heavy manufacturer's personal property tax review. And once amended, this company secured a perpetuating benefit of $1 million in property tax savings. Noteworthy is that property tax periods are almost always time sensitive to a particular period or a particular date during the year, and are generally starting around March 1st and ending by June 1st of each assessment year. Assessment notices also typically carry a short appeal window, normally 30 to 45 days, but as short as 15 days. So again, it's important to know your state, but it's also important to know whether there are some jurisdictional differences for those deadlines. So monitoring your assessment notices, which typically carry a very short window of time for protests, is a key step for executing your property tax management strategy. If you were to leave this presentation today and only take one thing away from this, this would be your biggest takeaway. I suggest that you do not go at this alone. Bring experience into the equation. Bring in someone who's been there before, who understands how to advocate, how to analyze, how to translate the loss in value that you're seeing from COVID, and to build that into your property tax management function. Start early, at least 6 to 9 months. Plan ahead so that you're not in a hurry to respond when notices come out this year or return filings are due. Doing that will put you way ahead of where you're at now because you'll be meeting the protest deadlines. You'll keep your options open for reducing your assessments and achieving refunds and tax reductions. Bringing in that seasoned expert will help you with creating that credible analysis. So that's important as the basic building block and foundation for a successful appeal strategy or a successful return strategy for an efficient property tax management and reporting method on filing. It will help you improve company profits by increasing your tax savings that you otherwise would not be able to achieve without that experience. At JM Tax Advocates, we're here to help. We're prepared to help you with building your business case. Feel free to call on us as your experienced team, your experienced advocates, so we can help you with making sure that you're spending your money wisely, that you're not overpaying the government for property taxes, and at the end of the day, aren't seeing unexpected surprises because of the planning that really should be part of your annual property tax management function. But whether you hire JM Tax Advocates or some other advocate, it's important to build that experience and evaluate the best possible resource that can tell your story during these uncertain times. This is a big burden area, and it's something that you cannot ignore because the impact to your business is not just short-term, but possibly long-term because of the increasing burden of property taxes on your capital-intensive business. So at this time, we'd like to open up our presentation for questions. So feel free to add these to our chat room so we can answer these for our attendees. I'm going to leave my contact information up on the screen so you can just go out on our website and log into our contact page. I really appreciate the opportunity to present these strategies to you today. It's been a pleasure. I wish you well during these uncertain times, and I wish much success to your business. Feel free to call on us as your experienced team, your experienced advocate, so we can help you with making sure that you're spending your money wisely, that you're not overpaying the government for property taxes, and at the end of the day, aren't seeing unexpected surprises because of that property tax planning that really should be part of your annual management function.